Thank you so much. Mr. Tripathi, firstly, the APE has grown 13% on a year-on-year basis. What were the key factors that contributed to this growth?
I think we are doing very well across all the channels, especially our proprietary channels. And while on APE basis, you see the growth at 15%, actually on collected premium basis, our growth is 23%, which is almost 3 times the private average growth rate. And we have seen growth across our prop channels have grown on an APE basis about 18%, the offline, and our Banca channels have also grown by about 16%. So as a result, we have seen improvement in growth numbers, as well as we balance our product mix compared to last year. We have seen about 6% reduction in ULIP, and that 6% increase in non-par mix. As a result of this, the 17.5% margin from Q1 last year has gone up to 20.1, leading to an overall VNB growth of 32%.
All right. Prashant, this is Kanishka also joining in. Congratulations on that great set of numbers. You were just talking about the VNB margin, that has improved from 20.1% to 20.1% from 17.5% earlier. So could you help us understand, were there any specific initiatives or changes in product strategy that drove this kind of improvement? Can we expect a similar trajectory in VNB margins going forward as well?
Yes, Kanisha, thank you very much, and good morning to you. We typically like to keep our ULIPs at a company level between 35 to 40%. And unfortunately, with how the market was moving last year, we actually landed between 40 to 45. So this year, first quarter, we actually managed to bring it back between 35 to 40% range. And we saw this 6% reduction versus last year. And that we actually increase our non-par mix through launch of a very innovative non-par design. It is called S5 Smart Vibe, and that has the key reason why the non-par mix has gone up. Equally, our focus on protection, annuity, and riders remained really strong. Our protection grew by 36%. Our riders grew by more than 300%. Our annuity grew by about 40%. So our product mix adjustment actually led to the increase in our margins, and we are very hopeful that some of these trends will continue, and we are very optimistic that the guidance that we gave to land between 24 to 25% next year, we stick to that.
Right. Moving on, coming to you for the next question then. Also talk to us about, can we, despite a strong performance, the solvency ratio declined to 1.9x from 2x. Now, what were the key drivers or the factors behind this decline, and are there specific measures being considered to improve or stabilize it going forward?
That's a very good question, and it's a bit technical also. In insurance sector, the more you grow, the more you consume capital. So that's true for Max Life Insurance also, because our growth rate is very robust. We are growing quite substantially, as well as our focus on driving protection and non-par is of a higher order. That part of the business consumes more capital, and hence you've seen our solvency to go at 1.99. Though it remains in a very healthy range, and anything above 180 is really, really good. At some point of time, as we move along, we will look at raising more capital, firstly through debt and then through equity over next 12 to 24 months to ensure that our solvency always remains in good position. But this capital is growth capital, and we are very happy about that.
Okay. Mr. Tripathi, let's also talk about the Bancassurance segment then. Now that has seen a very significant growth, and the AP has grown by 16% on a year-on-year basis. Tell us more about, what's your long-term strategy for strengthening the existing Bancassurance partnerships going forward?
Yes, as you know, Axis Bank is our promoter organization. We are very proud of the relationship that we shared with them for last 15 years, and it contributes quite meaningfully and substantially to our growth. So I think we remain very optimistic about growth opportunities from Axis Bank, and our share on that counter is between 65 to 66%. But in addition, we have had a very meaningful relationship with Yes Bank as well, and perhaps our oldest Banca relationship. And we are registering good growth there as well, and we are maintaining our counter share. So those two are really large relationship, Kanishka. But over last 2 to 2.5 years, we signed up with 8 mid-sized banks also, and all of them have started to contribute. As a result of this, the new banks that we acquired are registering really good growth because we are starting from zero base, and you are seeing substantial growth from Banca channel as a result of this. So we remain focused. The long-term objective, of course, will be to deepen our relationship with both Axis as well as Yes Bank, but also drive growth through the new banks that we acquired and try to find as many banks as we could.
Tripathi, also finally tell us, has the impact of the surrender value changes, is that over or is it still due? And what is your outlook for FY26 as well as FY27?
Uh, Thank you very much. I think the surrender guideline came, and we really respect all the mandates, and this is really behind us. So I'm not expecting any further impact. And I think we have moved to the new zones. We are really not in the phase to ascertain the impact of surrender value. Whatever margins are coming are post the surrender guidelines change, and this is a new normal, and we're working on that. As far as the guidance for FY26 is concerned, like we shared earlier this year, we are targeting a high teen kind of growth number and a VNB number closer to 20%. So those are two numbers that we are going to work on. And hopefully, with the trajectory and the way we have started the year, I remain very optimistic that the new market opportunities, the growth, the new banks, new products will help us drive the strategy that is well in place. So those are numbers that we are working towards.
Okay. Thank you so much, Mr. Tripathi, for joining us and sharing with us the outlook, going forward in FY26 and 27. It was great chatting with you. On that note, we'll let you go.